I just got done watching this clip from Tom Lee on CNBC. The last part made me just laugh out loud when they called Tom Lee kind of crazy for making these short-term calls. But yes, he's back at it again. S&P 500 at, get this, 6,300 by the end of, not next year, by the end of this year, which would be an impressive move into year end. But in fact, the data actually backs Tom Lee on this one. Since 1928, the S&P 500 has posted an average overall gain of 1.3% in December. Gains have been positive 74% of the time, the best in monthly history. And stocks have been higher 9 of the past 10 Decembers in an election year. But Tom Lee is not just calling for a small gain. Tom Lee expects stocks will go up about 4.5% from current levels into year end, which would be one of the strongest Decembers we have seen in a while. In fact, this would be the strongest December we have seen in over 10 years. Matching almost the performance of 2021's December when you went up 4.3%. I'll take a listen to this clip from Tom Lee, and boy, do we have a lot to go over afterwards.
Our next guest sees the S&P rallying to 6,300 by year end, but says we could be entering what he's calling a zone of hesitation in the next couple of weeks. Joining us now, Tom Lee, Fundstrat Capital Chief Investment Officer and a CNBC contributor. It's good to see you, Tom. I want to talk to you about the bonds 10-year at some point, but you see 4 reasons why you still expect the S&P to continue to rally in December and maybe to 6,300 by year end. What are the 4 reasons?
Well, one is seasonality. December historically is a strong month, but when you're up more than 10% in the first half and it's an election year, December's been up 100% of the time. The second is yields have moved down to pre-election levels. You know, the 10-year's at 4.1. That's good for multiple expansion. The third is, I think it's been surprising, but sentiment's actually turned negative the last 2 weeks, even as the markets rallied. To me, that's a contrarian bullish signal. And then finally, we still have those 2 puts, the Trump put and the Fed put. And I think that means you still want to buy any of these dips.
What can Trump do to make sure the market keeps going up?
Well, I think we've seen it with how he's made cabinet proposals or nominations, that he's very pro-business. And I think, as many have said, Trump is very focused on the stock market. So I think communication is still a strategy, and it's a reminder that animal spirits could come back.
I don't know if you watch the way the financial, say this tactfully, I don't know if you watch the way the financial media industry covers tariffs. I mean, how can you call him pro-business, according to these people, when he's pro-tariffs? Because you would just think, you know, if you watch the coverage of tariffs.
Yeah, I mean, to me, it's a reminder that it's good to carry a big stick, and I think tariffs have proven to be a good negotiating tool. I think we've seen some proactive actions by other countries. And in general, I don't think the new White House wants to pursue any policies that would hurt corporate profits. So I think ultimately, whatever is accomplished is going to be pro-business.
That's interesting. All right, I hope everybody's listening. At least that's one man's opinion. Whenever we talk about like the 10-year, it's always well, it'd be good this way, but it would be bad this way. If it is falling, which is good for multiple expanding, why isn't that indicating that maybe the economy isn't as strong as we thought, and that maybe corporate profits won't hold up their end of the multiple expansion on one hand, but sometimes that's combined with a slowing in profit growth?
It is a possibility, and it's always hard to tell what the bond market is telling us. But when I look at the next 6 to 12 months, and we know the Fed wants to reduce the cost of capital for homeowners in mortgages and for small business owners, having the 10-year stay at these levels or even fall is actually an easing of financial conditions. So to me, that's a good sign.
Do you think that trying to, this Elon Musk, Vivek Ramaswamy thing, Do you think it's A, that they can make real progress, and B, would that be a positive for economic growth, or would it be a negative for economic growth because you're laying people off, you're spending less?
Well, I think it's great that someone is scrutinizing these.
Bernie Sanders said it was great.
Yes, that's right. And these are.
That's
huge.
not good. No, go ahead. Sorry.
Well, I mean, these are huge budget items, and so I'd love to see someone really identify where there could be waste. Mm-hmm. And is that bad for the economy? I think in general, most people view government spending as the least efficient capital. So if you reduce government spending, and it's been crowding out private sector spending, I'd rather see the private sector reinvest that capital. And I think that would overall be very good.
You sound like it's a zero-sum game. I mean, a lot of people would take any spending they can get, whether it's government or otherwise, for an economy, for juicing the economy.
Yeah,
You think it would go into private if it's not spent by the government?
Yes, that's right. I think that would free up money because this is, money, the capital that the government spends is competing with private sector money. I'd rather see the private sector invest this money at a higher rate of return. So I think overall it'd be positive for GDP and profits and for equities.
Do you want to, we always get a Bitcoin comment from you before we let you go. Normally it got stuck under 100. That's a pretty, it's a psychological level, I would imagine.
Yeah, I think some of this could be, there's a lot of folks who don't want Bitcoin over 100,000, and some of it may be the exchanges themselves are concerned because there is a pretty low supply of Bitcoin available over the counter. So you have a supply shortage, and if Bitcoin makes a move above 100,000, I think there'd be a big chase. So I'm still confident Bitcoin's going to close much higher before year end.
Before year end?
Before year end, yeah.
So break $100,000 before the end of the year?
Yeah, well above 100,000 before year end. It's just a matter of time.
It's December 2nd. It's not that long, Tom. So it's going to do it in the next 4 weeks.
Tom makes bold short-term calls.
I know, you're nuts, and they all come, usually they come true. On a roll. All right, Tom Lee, thank you.
First and foremost, I absolutely love the point that Tom Lee made that sentiment has actually gotten really bearish over the past 2 weeks, because he's true. If you look at the AI Investor Sentiment Survey that asks investors, what direction do members feel the stock market will be in the next 6 months, hit a new 1-year bearish high. So meaning, people are more bearish now than they were during the growth scare in September, and the yen carry trade blow up August 5th of this year, where stocks actually went down 10%. No, they're more bearish now. That's a wild thing to think of, as stocks are at all-time highs, just going higher and higher. I think some of it has to do with your year-end price targets for next year coming out that are 10 to 20% higher from current prices. People are saying, maybe if Wall Street is this bullish, it's time to be a little negative. That, as Tom Lee says, is a contrarian bull indicator, and I tend to agree. Now, the 1-year bearish high was set on November 27th, just a couple of days ago, at 38.6%. This is a 1-year low for bullish investors at 37.1%, and neutral investors at 24.3%. So you've effectively went from 49.8% of investors bullish as of November 13th. Fast forward 2 weeks to November 27th, and only 37.1% of investors are bullish. That is over 12% drop in the amount of people that feel bullish. That's almost unprecedented in recent history, unless you're obviously in some kind of deep decline, in which we are not. Now, here on the day today, the NASDAQ is up 0.8%. The S&P is up 0.15%. The Russell is up 0.12%. And the Dow is down 0.25%. The VIX is up 1% today to 13.65. But all of this is pretty remarkable given over this weekend, Trump threatened a 100% tariff on the BRIC bloc of nations if they act to undermine the US dollar. The countries included in this are Brazil, Russia, India, China, South Africa, Egypt, Ethiopia, Iran, and the United Arab Emirates. So let's get this straight. Trump threatened a 100% tariff on India and China, two of the most important countries as far as international trade with the US, and stocks are green? Wow. Okay, maybe if some tariffs actually start to get implemented, our market's going to be fearful, but given all of the fear Wall Street has around tariffs, it's just not pushing our markets lower. I would say that's bullish, at least from now into year end, because I mean, nothing can get enacted, right? From now until inauguration, at least. And now we already have a threat of 100% tariff. Like, who cares? Go to 200%. The same point would be accomplished. There would be no business from India or China in the US. Like, doesn't matter what the percentage is over 100%. Nothing's going to happen, right? There's no business going to take place. Now, is that going to happen? Obviously not. That would cause a recession in the US. Like, clearly that would not happen. And maybe that's what the markets are figuring out here. But I mean, when I put all these things together, this seems exceptionally bullish for a year-end rally. Now, I will also note the percent of stocks currently trading above their 50-day moving average is up to 66.67%, up 0.32% today. You've been trading in this range between the high 60s and the high 40s as far as percent of stocks above their 50-day moving average. I will remind you, the year-end rally that we had last year from November through December, a lot of it was just anticipating a bunch of cuts from the Fed in 2024. The percent of stocks above their 50-day moving average got as high as 86.5%. You're at 66.5% today. So you could go up 20% from here before you're really euphoric. And again, a lot of people say stocks are too expensive, that markets are too bullish. And in fact, you see from the AI investor sentiment survey, that's not the case. People are actually very bearish right now, believe it or not. And the percent of stocks above their 50-day moving average is kind of at a normal level. Like, you're not super, overstretched in terms of the markets. And if Wall Street does start a chase into year end, and or Wall Street gets more bullish on small caps and mid caps and cyclicals, and some of this bearish sentiment dies down over the coming weeks and some of the bullish sentiment picks up, you have a perfect storm for a year-end rally. Now, let's not be confused here. I'm still expecting that we will get some kind of correction in Q1 2025 after a year-end rally. If Tom Lee is correct and markets hit 6,300, I would firmly expect a pullback back to the 590, 580 range or so. I think that would be a likely case scenario. And if we did hit 630 and came down to the 580 level, that would be like an 8% pullback. If you came down to the 570-ish level, that would be a 9.66% pullback. Down to the 565 level would be a 10.4% pullback. I am expecting something along those lines in Q1 of 2025, but I do think markets go higher between now and then. Sentiment for the SPY today, which is the ETF that tracks the S&P 500, is bullish today at 56. Yesterday, it was neutral at 47, so that looks pretty good. Message volume was low yesterday at 33. Today, it's normal at 48. And the participation ratio today is high at 55. Now, we did have some really, really good news today as far as the economic data. As I talked about previously, the November ISM Manufacturing Index came out today at 48.4 versus 47.6, which was the estimate, and 46.5 in the prior month. So this was actually almost a 2-point jump on a month-over-month basis. Get this, new orders are now in positive territory at 50.4 versus 47.1 prior. Prices paid down to 50.3 versus 54.8. And employment up to 48.1 versus 44.4 prior. So let's get this straight. Employment is getting better in the manufacturing sector, still negative, but getting better. prices paid, aka inflation, fell a lot from 54.8 to 50.3, almost in deflationary territory. And new orders skyrocketed from 47.1 last month to 50.4, finally in positive territory for the first time in a long time. That is all around good news today. CNN's Fear and Greed Index today is coming in at 67. Previous close was 66. Market momentum, extreme greed. Stock price strength is greed. Stock price breadth is neutral. Put and call options, extreme greed. Market volatility is neutral. Safe haven demand, extreme greed. And junk bond demand, currently in greed. The Fed rate monitor tool is currently favoring a cut December 18th. Probability of this currently 69.4% and a 30.6% chance of a continued pause for December 18th. And that's another potential catalyst to push markets higher after we get another cut from the Fed. Fed Bostic said his base case is that inflation remains on track to reach 2%, but he has not yet decided on a pace of cuts and the extent of cuts for 2025. So leaving that door open for more cuts or for less cuts. But he also says he does not want people focused on the view that there must be a cut at every meeting. He also says that it's still an open question how fast and by how much rates need to be cut to keep inflation declining while avoiding undue damage to the labor market. So a lot of your Fed officials recently have expressed that they're still a little concerned about the job market, that things may not be as good as some people think. After all, last month, we only added 12,000 jobs to this economy, which is a pretty damn recessionary number. And I think for the time being, this is keeping the Fed in a cutting bias, but it's really going to come down to the data on how many cuts we get in 2025. I don't think it matters too much as long as the economy is good. Now, if the economy gets worse and we get more cuts, it's hard to say if that's going to be good for stocks versus the economy's well and maybe inflation continues to come down and we get only a couple of cuts. Overall, let's bottom line this. Investor sentiment is quite negative around stocks. Believe it or not, with stocks at all-time highs, including today, people don't feel that good about our markets. So that's first and foremost. There is a lot of reasons to be optimistic about next year, including the data that is coming out today, which doesn't really make sense to couple that with a bearish sentiment for markets. A year-end chase with strong seasonal activity also supports a year-end chase. But I want to be clear, we will get a correction, most likely in Q1 of 2025. So this is not a buy stocks and be complacent forever type of thing. This just means maybe we get some short-term upside from here before a larger correction in 2025. So these are short-term calls, if you will. If you're a long-term investor, just take this information, with a grain of salt for the near term. 2025 is probably, after all, going to be a good year unless the economy starts to weaken. In fact, the data that we got today just does not support that. And we do have data out tomorrow with JOLTS job openings that will further confirm whether the labor market is weakening or not. Imagine it like this. If you're a business and you're looking to hire 5 employees, odds are your business is doing quite well. Now imagine, let's say in December, you're looking to hire 5 employees, or November for that matter, because this is October. Let's just go with the data, okay? October, let's say you were looking to hire 5 employees. Well, now let's say your business has, for whatever reason, slowed down. Now you're only looking to hire 2 employees. 3 job openings are now gone. That's not good. That's not a good sign for the economy. So this job openings number, if it stays relatively stable, that's a good sign. If it goes higher, that's a good sign. If job openings plummet or fall, that's a bad sign for economic activity. You're expecting job openings to fall from 7.443 million down to 7.38 million, with some estimates expecting 7.48 million. So, higher is better, really in line with expectations. is the best case scenario. Now, tomorrow as well at 10 o'clock in the morning, you will get the economic optimism index, expecting that will go up as well from 53.2 to 54.1. You also have Fed Kugler and Fed Goolsby that speak as well from noon to about 3 p.m. Eastern Standard Time tomorrow. So these things are going to be big catalyst for tomorrow and likely move the markets quite a bit. Let me know what you guys think about all of this information down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.